Hey, everybody, good to be here. My name is Brent Morse. Time for our weekly session on managing your options portfolio. And this week, we're going to talk about exits. We do that to one extent or another every week because that's part of managing an options portfolio. But we'll hit that up in just a minute. I'm joined alongside Mr. James Boyd in the chat. He's a longtime colleague of mine. And he teaches numerous webcasts. I know a lot of you are probably familiar with a lot of them, including an Investing Masters series. Make sure you check that out. That's on Tuesdays, 11 o'clock Eastern Time. That's also, as almost all of our webcasts, is archived as well. You can follow either of us on X at BrentMooreCS, at James Boyd CS. Let's hit up the disclosures real quick, and then we'll get to the main substance of why you're here. Options do carry a high level of risk and are not suitable for all investors, and the information today is for general informational purposes only. It's not a recommendation of any security, strategy, or chart pattern. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including potential loss of principal. The paper money application, which we'll be looking at here. This is going to be the Thinkorswim desktop software, which is what we'll be using. That is for educational purposes only. And let's see, past performance of any security or strategy does not guarantee future results or success. Glad you're here, everybody. Let me just bring up our Thinkorswim platform. There it is. And you know, something we do a lot of times is we'll put trades in, and when we put trades in, sample trades, we will we'll talk about max gain, max loss, reward to risk scenarios on these. And my main message to you today is the theoretical reward to risk ratio is not necessarily what our most likely reward to risk ratio is. Let me give an example. I have Goldman Sachs up here. I have a chart. Stock's been going up. It's been real strong. Trends up. Some technicians may say, hey, you know, they consider a bullish trade on that. And if we do that bullish trade, here I have a short put vertical spread. And, you know, it doesn't matter. The details of it don't matter necessarily. But if I click on confirm and send, and so this is a 645, 640 put spread. My max profit is 152. My max loss is 348 on that. You can see that max profit, and you could construct a reward to risk ratio from that. You take your max profit, 152, divide it by 348, and I come up with about 43, 44% return on risk. You may say, oh, that's great. Let me get rid of that. That's old. So you can divide one by another for your reward to risk ratio. But what I want to ask you is this, is what are the odds we're actually going to take a max profit on that? Particularly since we usually close these out before expiration. And what are the odds we're going to take a max loss on that, given that we usually close these out before expiration? The answer is it's going to be a very unusual circumstance where we actually achieve the max profit or the max loss on these trades, because we don't hold these all the way to expiration. One reason, maybe not the only reason, but one reason is short options can be assigned early, okay? And the closer you get to expiration, the more likely that early assignment occurs, okay? But even with that, you know, you get more, a lot of times you get more gamma risk or more risk in the trade swinging from, you know, good to really bad in just a jiffy. And we try to be more conservative on that often. And so we're not going to actually see a max profit or max loss. So the message is, number one, we may use this as a measure to try and help us decide whether the initial conditions are correct, but it doesn't mean that that's actually what we're going to get in our trades here, okay? So that's the first thing I want to mention here. There are different reasons to exit. One reason we may exit is just a time exit, Or maybe we've achieved a certain level of gain that is a good gain, and maybe there's enough time left in the trade that it makes sense to get out. So very often on these, say a short vertical, we'll say, oh, if you've achieved an 80% of what you can possibly make, we're going to get out. Okay, so 80% of your max gain, we're going to get out. Or let me give you another one that I want you to think about. This is if things go very well quickly, it's unlikely we're going to hit 80% in the first few days of the trade. The stock would have to make a massive move. But if we could hit maybe 50% gain in half the time, half the potential gain in half the time, then we may look to get out. And I want to show you how to actually enter a trade like that. Okay, half the gain in half the time, we may get out of that trade. Now realize that's going to kind of mess up our theoretical max gain, max loss scenario, because we're only going to be accepting half that gain. Okay, but we also may put in a stop loss at the same time. Or in the chat, Paul said 50% of the gain in a quarter of the time. Well, let me show you how to do it, and you can decide how much time you're going to do on this. But let's do this. So here, let me pull up a different stock here. And Goldman, yeah, seems like a nice trend on Goldman there, right? So here's GE. Okay, GE, I'm going to consider this to be more bullish. The trend is up. We're back above our 20-day moving average, which seems like we have a pretty decent support level in this area. It's been going up, and let's look at, see, well, how high is this going to go? Well, I don't know. We recently hit 257 as a high. So what if we target around 255 on that? Okay, and we can kind of consider that a target. And we're bouncing up, and I'm going to do, maybe we'll do a spread. Let's do a long call vertical, Okay, now, if you're more bullish, maybe you just do the long call. But I'm going to do a long call vertical here as an example trade, and I want to kind of work through the math with you on this. So let me go to trade, and I'm going to go out here, and I'm going to go, we have a vertical up here. Let me just go to single for a sec. We have strikes every $5 on this. I'm going out about a month here. Okay. And I'm going to look to do, say, a 245 long call. I'm going to look to sell a 255 call. There's a spread. That's our max loss. That represents our debit represents our max loss on that. Let me confirm and send this though on this. Okay, max loss 508, max profit 492. So what would a 50% gain represent on that in terms of half of what we can potentially get on that? Well, half of 492, that's about $250, just shy of $250. But I'm going to use $250 just to make it easy for us. $250. If we get half of that in half the time, how could we do that trade? Well, here's what I'm going to do. Let me edit this. Let me edit this order, and I'm going to put a closing order in on this. And I'm going to right click on this, and I'm going to create an opposite order to get out. Okay. I'm going to create an opposite order to get out. And to get out of this opposite order, what I'm going to say is, look, if we're buying it for 508 and we're looking for a 250 gain, that's going to be about 750. Okay. 750, 760. So if we could sell it for 760, that's going to be our 50% gain. Okay. 760. Did you get the math on that? We said it was going to be a $250 the most we can, is going to be 50% of our potential gain on that. And so I'm taking that $250 and I'm adding it to our initial cost on that. Okay? And that would mean we'd be selling it for $760. That means it leaves a difference of approximately $250. Okay, I could do $758 to make it exact. Okay, so that's the 50% gain standpoint. But what about the 50% time standpoint on that? That's a limit order. That's a potential gain on this. And if we wanted to put a stop in, we could put in a stop as well. I'm going to make that good till canceled. Okay, but I'm going to add some conditions to this order. And I'm going to say, so for conditions, I'm going to click on the little gear over here. And I'm going to say, look, I want to, if we can get that in half the time, then that's great. Well, I'm going to cancel this order at some point. These are July 25th options. That's a month away. Okay, July 25th is a month away. Today's June 25th. And so I'm going to say, well, if I can go in half the time, well, let's go 1 week. Hold on one sec. 1 week is the 2nd. 2 weeks is the 9th. July 25th is there. So I'll go the 10th is about half the time. So this will cancel the order in half the time. So if we haven't achieved a 50% gain in that time pane, then this order is going to go away. It's just going to cancel out, and I will be left with just my initial order. And then I can use our other rules at that point and go on from there. I can let it run. Maybe we get a bigger gain after that, but that's how you can do a 50% of gain in 50% of the time. That's on a long vertical. That's on a debit spread. I want to give you an example of a short contract as well. We'll do the same thing. But let me confirm and send that. And I'm going to put that in our long verticals bucket there. And we just sent that as a potential trade there. Okay. Now, hasn't failed. We'll see if that fills. We can do a similar thing on short verticals. Let me give you a different example. Let me go to KHC, and I'm going to do a short call vertical example on this. Why short call vertical? Short call verticals are bearish trades. I just gave you an example of a bullish trade. Now let's do an example of a bearish trade. I just give you an example of a debit spread. Let me give you an example of a credit spread. So what's the trend? Trend is down, lower highs, lower lows. It seems like it's kind of doing this pattern. It goes down, retraces a little bit, down, retraces a little bit, down, retraces a little bit. But all the while, we're getting lower highs. We've been using this 20-day moving average as a support level, a resistance level recently. Okay, so I'm going to assume we're bearish on this trade here. And where's our stock? This is a lower price stock. Right now, looks like we may be bouncing right here around that's roughly the $26 level. So let's take a look here at this. Stock's at about $25.86. And let me go to KHC. I'm going to go a little shorter term on this. I'm going to go to our 18th of July options. Okay. So these are the weekly options. They're going to be a little bit more liquid than the weekly options. Monthly options are generally going to be a little bit more liquid than the weekly options. Now I can go out, and we said 26. We could also go, if we wanted to, go a little. We actually have strikes every 50 cents on this. Okay, so I'm going to look to sell this and I'm going to look to, I'll do a dollar wide spread, and I'm going to look to buy this one. Okay. So here's our short put vertical spread. Our initial credit is 19 cents on that. What would it be to make 80% of this? What would it be to make 50% of this? Well, 50% would be, we'll say, if we're selling it for $19 up front, and we may do multiple contracts because this is pretty low price, then if we got out at $10, basically we've made half of what we can make on this trade. Okay. What about 80%? Often we'll do an 80% gain on these. Well, $19. The easy way to kind of consider that math is just multiply this by 2, and so 19 by 2. I'm going to say 20 by 2 is 4 cents. So 0.04 cents. If this price right here hits 4 cents, we've made 80% of what we can do. Do you see what I did? I took the full price, 19 cents, and I subtracted 80% of that, which is basically the same as multiplying this by 0.2. Okay, and that gives me 4 cents. 4 cents means that we're going to get out of this at 4 cent credit on that. Okay, so that'd be 80%. Now notice the difference there. I've talked about 50% today of if we're going to go half the gain in half the time. Now you can do half the gain in a third the time or whatever you want, but half the gain in half the time. But if I'm going to let it go further, maybe I do an 80% gain, and I could say, then in that case, it would be 4 cents in that case. Okay, so let's do this. Let me put in, that's my initial order. And if I want to put in this trade, I can first put in a first triggers OCO order. Okay, I'm going to right click on this. I'm going to create an opposite order, and I'm going to have 2 of those. One of those is going to be, hey, if I make an 80% gain, I'm not going to do the 50% profit in 50% of the time. You know how to do that at this point. But what I can do is I can say, if I've made an 80% gain on this, and we said that was going to be 0.04, okay, 0.04. So it's just going to automatically buy it back at that point. Limit order, good till canceled, okay? What about our debit? What about if things go against us and I do a stop order on this? Well, I can, and let me just be clear. Very often on short verticals or long verticals for that matter, because it's a vertical, a lot of traders don't deem it necessary to use a stop. That's the reason we're doing a vertical spread in the first place, is we're capping the losses by having a spread, okay? But if you are going to do that, just be aware, when we pull this up initially, and we have a 20-cent credit here in this case. This is a higher probability trade, but low credit. Our reward to risk ratio gets thrown off when we say, I'm not going to take my full potential gain of 20 cents on this. If I'm getting out at 4 cents, then really that's limiting my gain to 16 cents. That's going to throw off that reward to risk ratio. In terms of my stop, well, there's a lot of risk on this trade. Okay? This potentially, it's a dollar wide spread. This potentially could cost us $1 to get out. Now, we brought an initial credit on this, 20 cent initial credit. So we're not losing the full dollar, but that's like an 80 cent loss on that. Well, I want to cut that in half. I'm going to cut that to about 40-cent loss. So that's if it goes completely south on us. So I'm going to go and put it 40 cents. Now, stops are not guaranteed. This does not guarantee we're going to get out at 40 cents, but that's going to be a stop order, good till canceled. It's a first triggers OCO order, meaning if once this order fills, if this order fills, And my price has changed a little bit here. So we'll actually get, the credit will be a little bit more on this. But once this order fills, then I have two sell orders. We'll call it sell order A and sell order B. Whichever one fills first will cancel the other one. That's the OCO part of that. Okay, so let's do this. Let me go here, and I'm going to go mid price is 20 cents, natural price, oh, you know what, I'm back to 19 cents here, I think, to fill that, okay? I'm going to confirm and send, and we're going to put that in our short verticals bucket. Okay, so we're going to send that. Those are just some examples. That's a bullish example. That's a bearish example. But I want to talk about exits in general today. And so let's go here. We just entered this trade on KHC. We have some other short vertical spreads that we're in right now. If you look at this, you'll say, well, we've got a short put vertical and a short call vertical spread. This is an iron condor, yes. And one rule that we often use is when we're under 10 days till expiration, here we have 8 days till expiration, we look to exit these trades. This is why, this is an example of why the max gain and the theoretical max gain and theoretical max loss are not going to be attained typically. The stock right now is at 302. My short strikes are at 275 and 330. This is like an ideal scenario on UNH, okay? The stock has stayed right in the middle of our short strikes for our iron condors. Well, how much have we made? Well, we've done well. We've made 87% on this trade, okay? That's great, 87, but we can continue to hold on and try and bleed every last bit out of this trade, but under 10 days, we're going to look to exit the trade. Under 10 days, we look to exit the trade. We're going to be happy with the gains we have. So I'm just going to exit out of this trade. And this is an iron condor, but even if we were just looking at these individually, which is often what we'll do, and we've made, if we're under 10 days on these, we're going to look to get out of those in this class. Remember, on each trade, we're going to have a time exit. On each trade, we're going to have maybe we'll call it a stop exit, even if it's not a true stop. An exit if things go south on us, put it that way. And we'll have like a target exit, typically. Okay? So if things are going well, if things are going poorly, and if things are just kind of going and we hit a certain time. In this case, this one's going well, and we've hit that time to exit on this. So I'm going to look to exit this trade. By the way, on iron condors, often it'll be easier to exit if you don't exit the whole thing at once, the whole iron condor at once. But if instead you get out one vertical spread at a time on that. So let me do this, just make sure we confirm and send. We're going to send that. Let me go back to my monitor tab, and I'm going to get out of this, and I'm going to close this guy. And mid price is 13, natural price 17. Probably unlikely we're going to get filled at the mid price there, so I'm just going to go up a little bit from that. Confirm and send and send. Okay, we're out of that trade right now. We've had a nice little profit on that one, okay? So let's move on. Long single options. Let's talk about long single options. I entered 2 of these in a class yesterday. 2 single options in a class yesterday. One of them, we got lucky, folks. Normally it's just not going to go this well. We're up 56% after one day. I don't want you to think that's normal, but it's happened. I was kind of rushed. I did not put any stop in on these, okay? I did not put any stop in these. And so what I'm going to want to do is I want to add a stop on this. This is just a long call on AMD. Okay. Well, this is what happened. Okay, since we got in somewhere down here when the stock was somewhere down here, and it's a long call, and the stock just took off. So let's put a stop loss in on this. The delta on this trade is right now around 65. Okay, around 65. We entered this around 570. The option right now is at 890. What if we put a stop in where our initial trade price was? Okay. Now, that doesn't guarantee it's going to fill exactly at that level. It doesn't guarantee that. But if we were to get out that level, that means if AMD were to just turn south on us, we're not losing anything. Okay, I'm not factoring in commissions in these trades. Okay, again, stops aren't guaranteed, but that's what I'm going to do for that stop. So here's what I'm going to do. I'm going to just right click on this, create a closing order. We're going to sell it. I'm going to make this a stop order. And we said, I forgot the price already, 570 was our initial price. So this would get us out at no loss if indeed it were to fill at that price, not including commissions there on that. So I now have, I'm going to confirm and send that, confirm and send. We now have a stop. Maybe I'll sleep a little better at night knowing that AMD is doing well. Now, here's the thing. If the stock, the assumption is this is still going up. If you turn bearish on this and you think it's going to go down, then you don't even put in the stop. You just get out of the trade at that point. Let's look at Pepsi. Pepsi, we put in a long put yesterday in class. Okay, I put these in, by the way, if you're interested in a getting started with options class yesterday. So, kind of a similar thing. We're doing well. It's not up 55%, but it is up 19% right now on this. So it's doing fairly well. The current price on this is the current price on this is 410. The trade price was 340. So am I going to put a stop in at our initial trade price? The answer is no, I'm not going to do that. And here's why. If I take 340 and divide it by 410, that's about 83%. In other words, that would be putting a stop in approximately 17% below the current price. Now, that may be very appropriate for a stock trade, but for a long put, that is pretty tight. On this one, when we were looking at AMD, it wasn't nearly that tight. It was like 40%, not 17%. So we could do that. So in theory, it's nice. It's really nice to be able to move that stop up to the point where if we did get stopped out of that level, we wouldn't have any loss. But in this case, no, I'm not going to do that. I'm going to put my stop in at 50 to 60% of what this price is, of the current price, not my initial trade price, because it's doing well. So I'm going to take 415. I'm going to divide that by 2. That's roughly 210. I'm going to put in a stop around 210 on this stock. Now, the assumption is that Pepsi is still, that's not Pepsi. The assumption is that Pepsi is still bearish. Are you still bearish on it? If you are, then you would consider this trade. So I'm going to right click on this. I'm going to create a closing order. I'm going to put that stop in below. Our current price is about 410. We're putting our stop in at 2.10 to try to help protect us. That's going to be a stop order, good till canceled, confirm and send. Okay, so those are our long single options here. Okay, so we also, at the same time yesterday, that we put in, because I was kind of demonstrating in that class one of the differences between just a long put and a long put vertical. We did, and I don't normally do this, but I was illustrating something because we're kind of doubling up on the trade. I did a long put vertical on the same stock. One reason you don't do this is they're kind of, in a sense, the same trade. Yes, the long put has more risk than the long put vertical, but the fortunes are totally tied to one another. If one is doing well, the other one is probably going to do well. If one does poorly, the other is probably going to do poorly on that. So, but it gives us an opportunity to manage this. Okay. So, what's our current price on this? Well, the current price on this is the difference between these. It's about $1 difference on those. $1, okay? So this is a debit transaction. We want this value to go up. We want that value to go up. But I'm going to put a stop on this just in case it goes against us. And so what I'm going to do is I'm going to put that stop in at 50% of the current value. Current value is 1, 50% of 1 is, if we get out at 50 cents, then I'm going to look to exit that trade. This is not so Harry said, is this a ratio trade? No, this is not a ratio trade. I did put some ratio trades in the other day in our advanced options class. By the way, I invite you to that class. We teach that on Fridays at 2 o'clock Eastern time. A ratio trade has a differing number of puts and calls. In this case, I have a similar number of puts and calls on this. Okay. So there we go. Now, actually, I guess if you were to consider this along with the long single option, I put it as a separate trade altogether, yeah, that would be a ratio trade, but that was not the intention of the trade. We actually entered them as two separate trades there, Harry. So good question on that. So I'm going to put that stop in at 50% on this. Easy enough. I'm going to highlight it. I'm going to right click. I'm going to create a closing order on this trade. And this is going to be a stop order. And I'm going to make that 0.50. I'm going to make that good till canceled. We're just adding some protection along the way, folks, even if stops aren't guaranteed. Okay. So there we go. There's that. Let's move on to different types of trades. Let me just check my time. We're doing pretty well on time here. Let's look at, get a little more complex here. I've got CRM in here. This is a butterfly spread. Okay. We have some exit orders on this trade. Okay. Let me just click on this. It's a conditional order. So what I can do is I can go to working orders and we can look it up. Let's look at CRM here. There's CRM. Let's click on see what our conditions are. Our conditions are if CRM is marked greater than $280. Okay, it's going to get us out. Okay, that was just to protect us on this. And let's see. Yep. So that's CRM. But let me close this out so we can see. But remember our rules, and the rules basically we're using here are going to be the same there. We're going to have, if things go against us, we're going to have things, if they go for us. On a butterfly spread, what we want ideally is for the stock to stay kind of in this level, okay, 270. The current stock is basically 270. Here's what I would say. Number one, because we're under 10 days, we're going to look to exit. However, even if we weren't under 10 days, if we're showing a decent profit and our stock is doing this, we may consider exiting. Here is why. 270 is our target, okay? It could get better with time, This is a positive theta trade. Time decay is helping us out on that trade. Okay, it could get better with time. But what are the odds that the stock stays at 270 over time? It may, I don't know, but to be honest, it seems kind of unlikely. So what I'm saying here applies both to butterfly spreads and calendar spreads. Remember, on a calendar spread, we want the stock to go to a particular strike price, okay? Let's pretend we did a calendar spread at 270. And let's pretend, furthermore, that we're not 8 days till expiration, but we're 15 days to expiration, but we're at 270. Yes, the trade could probably get better, but given that it's unlikely the stock is going to stay right at 270 or close enough to it over the next week or so, we may look to exit that trade regardless of how many days till expiration. Now, that is not true. We're not going to hold to that if we just got in the stock, okay? But if we've got in that trade, but if we've been in that trade for a little while, even if we're not below 10 days, we're probably going to look to exit at this point. So what I'm going to do is I'm going to click on this. I'm going to cancel out of my other exit on that, and I'm just going to look to exit. So we're going to right-click, create a closing order. We're going to sell that and take a little profit on that. So that's nice. That one, we've actually, you know, some weeks we have more losing trades, some weeks have more winning trades. This week, we seem to have a bunch of winning trades. That's nice. Doesn't always work out that way, but I'm happy to take that when we got that. Now, that's not filling right now. If I want to push it to fill, I can right-click. I can be patient and let it sit. You can right-click and cancel that order and see what we got. Yeah, so I'm going to move this up from the mid price. It's typically unlikely to get filled right at that mid price. Okay, let's look at another type of trade here. And let me go to this. Let's look at Delta. We only have 2 days to go on this. What is this? What kind of trade is this, everybody? See this? What kind of trade is that on Delta? 2 days to go. We do have stock. We have 150 shares of stock in here. And so basically what we have is we have a covered call. Okay, yeah, George says covered call. Not all shares are part of that covered call. Only 100 shares. This controls 100 contracts, 100 shares, excuse me. One contract controls 100 shares here. So that's fine. Stock's gone up. We got in. Why did we get in this? Why do you get in on a covered call if you already have the stock? And we've had this Delta stock for a long time. We got in because our feeling was Delta was going to maybe not go up at the same rate it was going up. Or maybe it was going to have a temporary setback, but long-term we're bullish. Remember, on covered calls, you don't get in a covered call unless you're bullish on the stock. If you're bearish on a stock, then, and longer term at least, then you don't trade the stock, you get out of the stock, you buy a put on the stock, whatever. But if you're long-term bullish on the stock and you think, maybe it's going to flag a little bit or go down a little bit, but you don't want to sell the stock, then maybe you do a covered call. That's what we did. So very often on covered calls, what happens is the stock does well, the call does poorly, or the call does, in this case, we're actually up a little bit on both. And so as opposed to just holding the stock the whole time, adding that call in, we saved about $83 on that. That means the stock did not likely go up above our strike. Our strike is 53. The current price is 48. So you can see why we're profitable on that. Okay. So we only got 2 days to go on this. What you can do is you can say, look, I'm just going to get out of this, which we may do. Or we could say, maybe we're going to enter a new call option. This goes to something that I think it was Isaiah said earlier in the chat when we were looking at the Iron Condor that was doing well. You could look reevaluate that trade and decide whether it's one you want to, it still looks good. If we're getting near expiration, we may just roll it out into the future. Okay. In this case, we need to ask ourselves, are we bullish, bearish, or a little bit more neutral on Delta? Okay. If we're bearish on Delta, we may get out of the full 150 shares. If we're bullish on Delta, we may just get rid of the covered call, because that covered call presents a cap of potential on that. We don't want that. If we're more neutral on Delta, then we may look to roll out that covered call. So right now, we have a $53 June 27th call. When you're deciding what strike to roll out to, what expiration date to roll out to, it doesn't matter what our old expiration date was. It doesn't matter what our old strike was. We're not confined, we're not stuck to doing the $53 call. If the $53 call makes sense, then maybe we'll stick with it. But if it doesn't, it doesn't. So let's look with fresh eyes on Delta. I'm assuming for our purposes that maybe we have some resistance around here, around this level. And so maybe I'll put it the exit there. Maybe you view this as a more strong resistance. That's around the 53. That's generally where you're probably going to look for a strike, where you think it's less likely for the stock to go above. We can also use probabilities. Delta tells us how much the stock option moves in relationship to a dollar move in the stock price, but it can also kind of give us probabilities. And often we're looking somewhere in the 30 to 35% range, 30 to 35 Delta range. Well, 52 is about the 33. What kind of return is that going to give us if we went to the 52? Well, 130, I'll just go off the bid price, off a $48 stock. That's over a 2% return on this. If I want to be a little bit more conservative, lower the probabilities of it going in the money, approximately, rough estimate, 28% of it going in the money, we've got a 103 return. Well, what would a 1% return be over the next month? A 1% return would be about 48 cents. I'm just moving the decimal point over on the stock price. That means this is over a 2% return. I think that's reasonable. So therefore, what I'm going to do is I'm actually going to stick with that 53 strike. I'm going to roll this covered call out to the 53. It is, so I'm rolling it out, but we're not rolling it up or down in terms of strike price. Okay. It doesn't have to be that way, but in this case, it is working out to be that. So I'm going to stick with that 53. We're looking at June 25th. The way I can do that is I can go to the monitor trade tab. I can right click on this call. I can create a rolling order. It's going to say calendar. That's just the template we have. And I forgot our, come on, what was our, June 25th was our date. So I'm going to go to June 25th, July 25th, not June 25th. July 25th. There we go. That's giving us about $100 credit on that trade. We're bringing that in. It does not, doing this order template as a rolling template doesn't save us on commissions. Effectively, what we're doing is we're just closing out the old short call and we're entering a new short call. But that is bringing a credit in. I'm going to confirm and send. I'm going to go to, that's going to be in our long stock, and we're going to send that. Okay. And it's not filling. I want to show you what it looks like. So therefore, I'm going to actually push it a little bit, and I'm going to change that price. I'm not going to be patient with that. We're going to go down, confirm and send. Make sure I get it in the right bucket. Send. That I would think would fill. Still not filling. Okay, well, we'll have to wait and see on that. Surprised that's not filling. Let me try one more time. We're running out of time. Cancel replace order. We'll go right at the natural price. Short stock. Yeah, it's not filling for whatever reason. Well, I did what I can do on that. We'll let it go. Worst case, this just is going to this could expire in a couple days. I can jigger it. I can play with it a little bit after and see if we can get that filled. But that's rolling it out. Remember, when you have these trades and you're looking to close out, particularly if it's a time exit, like 2 days, 8 days, whatever, consider rolling them out. Certainly a valid possibility. Coming up next, we have trading price patterns. Barb teaches that webcast. Make sure you check that out. That's at the top of the hour. Thank you, James, for helping me out in the chat. Thank each of you for joining me today. And hey, what did we do today? We talked about putting in time exits on some of these trades. There, it finally filled. Oh, actually, that was a different trade that filled. We talked about putting in time exits on these trades. We also talked about trade management. We talked about a variety of different trades and the trade management of them. Thank you for joining us, everybody. Have a wonderful rest of the day. Bye-bye, everybody.